Yo, what's up, everybody? It is Tuesday, November 18th, and it was a no bueno day. Market's down. I did a little buying today. The markets came down. NASDAQ, S&P came down into an area that I thought we'd see some support, and it did bounce off the lows. But what I want to talk about today really has to do with the fiscal flows, which are not looking very good at all. Yesterday, we did have the quarterly interest payment, the November quarterly interest payment. That was 97, well, the total leading flow yesterday was 97.7 billion. It was like a 77 billion interest payment. Now, the leading flow was, was relatively good, but the net flow was only 54 billion. I mean, so 40 something billion came out of that from employment taxes. These employment taxes just keep skyrocketing, and it's weird because, we're seeing a weak labor market with layoffs. And just to give you some comparison, I'm going to try to run through these numbers. Just to give you some comparison, the August quarterly interest payment that we had back in August, that was an 84 billion or an 85 billion net flow. Okay, it was a 102 billion leading flow and an 85 billion net flow. So way more added to the swimming pool back in August. And even I look back the November 2024 leading, quarterly interest payment, and I forget the numbers off the top of my head, but that was also much more. Both, in the net flow was much higher. So we got a problem here, man. And I ran the net government transfers. I usually do this every Friday, but I just wanted to take a look at net government transfers. Right, that's the water level in the swimming pool. Now down 125 billion. We're not even 2 months into the fiscal year, and that water level has dropped. I mean, this is trending right now to like a 600 billion, if not more, reduction in net government transfers this year on an annual, if you annualize it, and maybe more. I mean, tomorrow or Thursday, we'll get that big monthly tariff drain. I mean, this is no good what's happening right now. I mean, there's no way that you can construe this environment as positive for stocks or even for gold or silver for that matter, risk assets. I mean, it's just the swimming pool is getting drained. I'm saying that we're down, if not below the skimmers right now on the pool. I mean, we're right there at the lowest level where the skimmers are just sucking a bare amount of water. This is not good. Now, I keep saying, I don't know what's going on with the foreign sector. It's very hard to quantify that, all right? It's not like there's some kind of daily treasury statement for the foreign sector that I could look at. So I keep telling you guys, well, look at the dollar, which was up for most of the day, but then it ended up down slightly. I'm looking at the dollar index. Again, we don't get the trade deficit numbers. We get that on a monthly, and that's 2 months behind, but still we can look at the trend of that. I don't know when that next release is coming out. I have to look. But this is really no good. I mean, Trump's talking about trillions and trillions, 17 trillion coming in. There's no evidence that I could see of that. I mean, I don't see it in bank credit. I don't see it in capacity utilization, industrial production. I mean, in reserve balances, not that it would change anything because dollars are all here. It's not like they're coming from somewhere else. Dollars only exist on the books of the Fed, at least, the electronic dollars, reserves, deposits, stuff like that. I'm not talking about paper dollar bills, which are just a fraction of the dollar supply, maybe, in people's mattresses or whatever. So I don't see any evidence of that whatsoever. There's reports, countries committing, they're going to do this, they're going to do that. So far, it hasn't happened. So you got to stick with these fiscal flows, and they're not good. I don't know how else to say it. They're not good. They're very weak. They're contracting. Net government transfers now, like I said, this is recessionary stuff. If you're talking about 600 billion, what's that, like a 2% drop in GDP without any multiplier whatsoever? So if it's 4%, you're cutting it down to 2, and really most economists would put like a 3 times multiplier on something like that, which is a 6% drop in GDP from 4. So, you're negative. We're negative. And again, I don't know what contribution the foreign sector is making. I'm trying to, come up with ways to get a handle on that. Some of you have made some suggestions, which, a couple of those were pretty good. Look at commodity prices, etc. But I don't see any indication of that, at least not in a way that would make me feel like we're seeing some kind of an offset. Taxes are draining big time. Individual income tax deposits to the Treasury way up this year compared to last year. I think that has something to do with last year we had a couple of these IRS tax extensions for storm affected areas. I said last year that this was essentially like a temporary tax cut. So we felt the benefit of that last year. Now it's getting taken back. We don't have the extensions now. All right, so something, Trump's got to send out, he said he's going to send out the dividend checks to people. I don't even know, if that happens, that's probably going to be a one-time thing. You need something to offset these tariffs. These tariffs are doing a lot of damage. And so the environment right now, I cannot be optimistic. That doesn't mean we won't see a bounce here and there in stocks because they can get oversold. I did some buying today. I think maybe I mentioned it. If not, I'll say it again. I did some buying today because today looked a little panicky, at least in the morning when it was down sharply. We didn't close good at all. And normally I don't make any assessments based on a one day's trading activity. I just don't do that. But what I'm going on is the fiscal flows. I did some buying today in some tech stocks, in some of the big bank names, stuff like that, at the lows of the day, which is what I always do. I always buy panic, okay? Maybe I'm early sometimes, but when I see panic, to me, that's an expression, that's a highly emotional condition. I always tell you guys, take advantage of when people are emotional. Maybe you want to wait for a certain chart point. I don't. If I see panic, if I see high emotion, I go in, I buy some. So I was doing some buying today. It's not like I'm putting all my eggs in one basket on any particular day, but when I see that kind of emotional condition, I go in and I buy some. So I don't like what's going on with the flows. I don't see any real recovery from the reopening of the government. I think that's just, I don't think that's going to happen to a degree. It's going to happen, but it's not going to happen to a degree that is going to reverse this trend, which is these shrinking transfers. It's the tariffs. It is the end of these IRS tax extensions where the tax drain is, it's huge right now. If you look at the differential, year-over-year differential in individual income tax deposits to the Treasury, It's brutal. All right. It's like everything that's being transferred in leading flows by the government, by government spending, most of that's being sucked back in the form of taxes. So it's not a good situation. It's a bearish situation. I would say that if we get any rallies, you might want to play it on the defensive side. Look, I don't do shorting. It's not that I don't recommend it, but I told you guys a lot of stories about my history of shorting markets as a floor trader. What I do when markets are in a corrective mode or bear market, I accumulate stocks. Okay, this is how I build my personal wealth. I accumulate. Own assets. I've said this in the past, that America is a fantastic country because it's set up, its economy is set up, it's called an ownership economy. They tell you, the politicians have told us for decades, going back to George W. Bush, it's an ownership economy, probably before that. So you have to own assets. Working at a job, maybe some of you, are lucky to have good, high-paying jobs that are secure. But working at a job is not the way. You have to own assets. And it took me a really long time to realize that. I mean, I spent most of my life trading in and out, which, it was fun and it was exciting and it was an adrenaline rush. But it wasn't until I understood, you got to own assets. So when they go on sale, that's the way I play it. I'm not saying to you, don't short. We just had this guy, and I should have known because a week ago, I think it was last week. It was last week when this guy, Michael Burry, the famous, what do they call him? The Big Short guy, who got lucky and made his money during the mortgage crisis back in 2007, 2009. I always said, because this guy stayed bearish after that for the whole entire time until last week. He closed down his hedge fund and he said, there's better things for me to do, meaning I'm sure he pissed away all his money because that's what happens. Same thing happened to a guy like Jim Chanos, who was a big short seller. All these short sellers, they go out of business, all right? They make a big score. I had the same trajectory. I mean, because I traded from the short side for so many years as a floor trader, and we all did. It was a weird thing. It was like some kind of weird, mind screw, some kind of weird mental illness that most of us on the floor in the pits, we were always trying to sell. The only guys that really made any big money were on the buy side, with the exception of the guys when I traded in gold, where we were always buying, in the 80s and the 90s. We were always buying every breakout to the upside, and eventually it just gave way and dumped. So Burry's out. All these short sellers. You don't hear a lot about John Paulson anymore, the guy who made $1 billion or something, because he had Goldman Sachs structure a fund, an instrument that was designed to blow up in the mortgage crisis, and Goldman sold it to some unwitting German Landesbank, which Goldman pleaded fraud. They were charged with fraud and basically, they admitted it, and they were given a slap on the wrist. Anyway, I digress with this. The monetary condition is no good. Fiscal flows they're very weak, and they're getting worse. I mean, we're looking right now at a $600 billion minimum. I'm saying, without any kind of an offset, like Trump sending out these dividend checks, these tariff dividend checks, and now he's talking about doing it next year. You're looking at a $600 billion minimum annualized drop in net government transfers. And again, that's right there, that's 2% of GDP. And it could be bigger than 600 billion. Right there, that's 2% of GDP taken off. And that's without any kind of a multiplier. So it's not looking good. Anyway, that's it for and I think treasuries are the place to be, even though these idiots at the Fed keep talking hawkish. But the economy will force their hand. It'll force them to change. And right now, nobody wants treasuries. Everybody's scared. You had a little bit of a drop in the yield today. I think it got down to 409 on the benchmark 10-year. But to me, that is as undervalued as the Treasury price was earlier this year, when the 10-year was up at what, like 480, 485, and we were at like, what was it, like a 4.25% to a 4.5% policy rate, something like that. It was ridiculously overdone, the price on the downside. So I'm still in that. Anyway, that's it for today, folks. Thank you for watching. Please like and subscribe. And don't forget to go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. Have a good evening. See you tomorrow. Bye.